Good morning, traders and investors. Roger Scott here, senior strategist for Wealth Press. It's Tuesday. It's April 18th. Man, oh man, this month is going fast. It's about 7:48 in the morning. The market's going to gear up to open up in a little less than 2 hours, about an hour and 45 minutes, give or take. I'm round balling it here. Now, as you noticed, I took off the short positions, most of our short positions, early this week or late last week because I saw that the market is turning positive. And right now, the NASDAQ is up about 100 points. The Dow's up 57 points. But I got to tell you something. We got to be really, really careful right now. Like super, super careful. Let me show you why. Look at the technicals on the S&P 500. Now, they look very strong right now, but I'm telling you, look at where we're at. This is the chart that's been setting up now. We've been in this range now since, since October. Oh, my birthday, October 29th, right here somewhere. Guess it wasn't a trading day on my birthday. It was a weekend. It was my birthday, of course. No, I'm just kidding. But anyhow, I was back in October. We've been in this choppy range since then. And again, we're reaching for that high level and the RSI is getting overbought. We got to be really, really, really cautious around these levels because the market can turn and start seeing some deceleration or some selling pressure. And as you could see here in the Dow Jones, we've seen exactly the same thing. The same type of trading action. So we got to be really, really cautious right now on what to expect. Looking at the bond market, let me just shift this a little bit here. As you can see here, we're getting towards oversold territory. Not sure if we're going to go down some more, but this may be a good buying opportunity. The problem is, with rates set to increase, I'm not sure if we're going to stay here or break down and go further. If we do go down further, which I think we may, we'll take this down another 3 or 4 basis points. And then we'll rally. Because look, the long-term trend is still bearish. We're still hovering right at the 200-day moving average. That's that ugly brown-colored line right here. And that tells me that if we break below this level, there's a really, really good chance we're going to hover down. So I would be very cautious right now. And I would much rather take trades to the short side than buckle the trade and trade both sides of this market. Because we know that Fed is planning on raising rates another 1/4 basis points, and we really don't know if there's going to be an end in sight or not. We don't know if this is going to be the last one or not. We honestly have no clue. It may be, it may not be, but based on what I'm seeing, the Fed's got a lot more work to do, and I think that even if they're not pricing in another rate hike, they're going to have it. I think maybe they'll cool off for a couple of weeks or a couple of months, and then it'll regain again, unless the country's going into a recession, and if the country's going into a recession, they're going to have to lower rates, but for a whole different reason. So remember, either way, it's very, very possible we'll rally, but I would much rather see us rally and then short the bonds versus go against the main trend, which has in fact been bearish. And again, I don't want to miss out. If we were down here, if we were at 100, I'd probably feel pretty comfortable about going long, but not at the 104 level because of where we're at right now. So wanted to kind of give you that information. Now let's talk about all the news and all the other goodies that are coming out. So 3 major U.S. benchmark indices ended the regular session higher as market participants digested a latest batch of corporate earnings, which is also why we're slowing it down on the trading for the next couple of days to give the market some idea of where it's going to go. Charles Schwab climbed more than 3% after the financial service provider topped analysts' expectations. Very, very positive. Alphabet fell 2% when they announced that Bing might be replacing the default search engine on Samsung's smartphones. I mean, like, people can't change it. I mean, really, you think people have to be stuck with it? People don't know how to use their smartphones, and if they want to use Google, they can't use Google. I mean, it's retarded for the stock to fall 2% based on that. And it's not based on the fact that Bing is a better engine. It's not. It's just some nonsense. So, again, we kind of have to use our brain with all of this stuff, use common sense. Monday's data showed New York Empire State Manufacturing Index rose to a 9-month high of 10.8 in April, stronger than the expectation of negative 18%, supporting the case for central banks to hike rates. And today you got President yesterday, Barkin spoke, and he said he wants to see more evidence that inflation is settling back to the central bank's 2% target. I'm not seeing any of that. U.S. futures are now pricing in an 85% chance of a 0.25 rate hike and a 14.6 of no hike. Notice 0.5 is not even on the table. And yesterday, this number was at 88%. So meanwhile, you've got earnings on Johnson & Johnson, Bank of America, Netflix, Lockheed Martin, Goldman Sachs. They're all slated to report earnings later today. Analysts expect the S&P to notch a 4.8 year-over-year decline for the quarter, a modest improvement over last year's forecast of 5.2% drop. I'll be watching this very, very carefully, and it'll be very interesting to see if the expectations go down or if they're going up. So far, they're moving slightly higher, but I mean, we've had 10 companies report. It's not really anything to write home about. Federal Reserve Governor Michelle Bowman is going to be speaking. That's why I got confused. Yesterday, someone else spoke. Yesterday, Barkin spoke. Today, Bowman is speaking for fresh clues on the outlook of rates. Europe is looking healthy. They're following Chinese economic data. China has been moving up in the last day and a half. They pointed to an even rebound while awaiting more U.S. banking news. A lot of folks want to hear how the banking is doing. So far, so good. China closed slightly higher as optimism over stronger than expected economic growth was largely offset by disappointing sub-data, including property investment and industrial output. Now, China's economy grew by 4.5% in the first quarter of 2023, making the highest growth since the first quarter of last year. Consumer spending ramped up. So China may be moving higher. Now, as I mentioned, earnings. I mean, boy, oh boy, we got Netflix reporting today. That's right. They're looking to be down year over year on their EPS, and revenue is expected to be up about $3.9 billion, and they can't use that password sharing nonsense. It's just not going to fly. But then you've got also Bank of America, Bank of Mellon, Fulton Financial, First Horizon, Goldman Sachs. That'll be very interesting. Interactive Brokers, Johnson & Johnson, Lockheed Martin, United Airlines. I mean, they are reporting. And then tomorrow we've got Tesla. So we have a lot of earnings on the table. So we have to be extra cautious right now. Extra cautious in where we want to put our money, because it's danger zone right now. And it's just a lot of volatility. Now, sectors, as you could see here again, sectors, technology is still leading, communication is still leading. But if you notice here at technology, I mean, it's still leading, but notice the last few days. They've been kind of choppy. And today, I don't know if we're going to open up and come back down. I don't think we're going to rally from this point. So be very, very, very careful. And what was driving the energy, which was the semiconductors, they are now not energy, technology with semiconductors. And as you could see here, they've been moving lower. So we got to be really careful. Matter of fact, they're building a descending triangle, which may bring us down. That's another reason why I'm so darn cautious right now. This market is just so overdone to the upside. Now, as I mentioned, technology, communication services are still the strongest one. It's interesting how communication services overtook technology when the chips started moving down. And if you look on a monthly basis, you still have communication, technology, but then you have healthcare and energy and then consumer discretionary. So we have strong fragmentation right now, like really, really strong fragmentation right now. So you got to be extra cautious. But today's Tuesday, and on Tuesday, I always give you the strongest sector, weakest sector, strongest stock, weakest stock. So let's look at the chart. Now, technology is still humming along, and it's looking really good. Communication is still humming along. Energy looks like it's turning a little bit south. Basic materials looks like it's humming along. Healthcare is super strong right now. I like consumer staples. That's kind of where I'm a big believer right now, because it's inflation friendly. Financials, as I told you last week, they look like they're starting to come up. This whole thing was overdone, just way overdone. Utilities looks like it's hovering along, and real estate is In my opinion, in terms of the strongest sector, yes, it's definitely technology, but I would be very, very cautious right now with it. I would stick with more industrial and utilities and energy, maybe not so much energies, but utilities. But let me show you the strongest stocks and the weakest stocks right now. Power. Now, this is a utility company, I believe. Industrial. It's an industrial company. I like industrial companies right now a lot. Look at the trend on this baby. And look at GE, also an industrial company. I'm really liking the industrial stocks right now, like a lot. So industrial stocks are definitely the way to go. And on a sector watch, let's see how they're looking. Let's see how industrial stocks are looking. Where is it? Looks like it's moving higher pretty quickly. It'll be interesting to see if it takes out 107, 101, 70. But right now, I like these industrial stocks. And to the downside, Match.com, don't like this at all. That is a consumer, a telecom. I would call this a consumer discretionary stock, but again, they want to put it in the telecommunications service sector. I don't know why. It's a consumer discretionary stock. And then Live Nation. It's let's see, is this consumer, also telecom, recreational? These are consumer discretionary companies. These are concerts, going out to concerts, dating sites. That sounds like a lot of consumer discretionary. If they want to put it into telecom, that's fine. But that sounds like it's a data processing. Maybe technically speaking, but that's not what brings money into Match.com. It's a consumer discretionary stock. So with earnings and with all of this craziness right now, we got to be really careful. So Match and Live Nation, I would be selling, and GE and Power via Quanta, I would be buying right now. Again, be really, really cautious. Be really, really cautious with the QQQ right now. It looks like it's getting a little toppy around these levels. And it's also, look, the RSI can't even get up to where it was before. So this divergence is pretty strong. Let me show you what I mean. Let me get a clean chart of all of this here. Here, let me do this. Clear all the studies. Clear all the tools. Let me show you what I'm talking about. Let me put the RSI on here. Relative Strength Index. There we go. So let me show you what I'm talking about. Moving up here, right? Moving down here. See this divergence? It usually doesn't sustain itself. And I don't know if we're going to break out from here before cooling off. I actually think the market may be suckering us in right now to go long for absolutely no reason, because look at where the SPY is. It's right at that resistance level. And there's a lot of sectors right now. There's a lot of sectors that look like they could be cooling off, like energy, healthcare, and utilities. They look like they're a little overdone right now on a 20-day line. So we got to be really, really carefully, especially with earnings right now. Now, folks, I discovered a brand new trade alert after sorting through my pattern trader hit list with my assistant Matt. We've nailed 31 out of 45 trades since the strategy began in May of 2022. That's like a 70% win rate, around there, 69, 70% win rate. And I want to do everything in my power to make these trades available to you. That's right, to you, or anyone else who wants to receive them. That's right, I'm talking to you. I'm holding a special class today at 1 p.m. Eastern Time. That's right, 1 p.m. Eastern Time. Today's Tuesday. It's the 18th of April. Jeez, I'm forgetting what month we're in. And I want to bring them to you. It's happening at 1 p.m. Eastern Time today. Don't miss out. I'm going to share all the details of the strategy, and I'm going to make you a special offer you can't refuse. Follow the link below. Sign right now. Don't delay. Don't procrastinate. We're going to have a great, great time. I'll see you soon. Like these videos, subscribe to our channel, and subscribe to our Telegram channel too. Bye, guys. Have a great, great Tuesday. Stay warm. It's getting cold again here in Florida. Bye.